We are going to start this training series right out of the gate with the most important part of the equation when it comes to landing larger commercial deals. It's not finding deals, it's not analyzing deals, it's raising capital for the deal. So you do not have to have your own access to capital as a bottleneck to your growth. You may have $200,000 to $300,000 in the bank to land your first $1 million property. Do not touch it. You want to be raising capital from day one, and raising capital actually starts way before you find an actual opportunity or deal. Just think about it. There's this sick mantra out there of, oh, find the deal and the money will come. You have to have the relationships first. Not saying you're going to be collecting money from people and putting in your bank account and finding for a deal to come. It's really changing your identity around real estate and you with your sphere of influence, your ever growing tactical sphere of influence, which we're going to actually cover that on future training sessions so that you can have a war chest of capital that's so abundant you never have to pass on a life-changing real estate opportunity. So in this episode or this show or this installment, we're going to go over the 5 sources of capital that you can raise for your real estate deals. And I'm going to start and preface this by saying, my name is Matt Druin. I'm a commercial real estate investor. I've been doing this for 18 years. I started with a 4-family property back in 2006. Started with $16,000 of my hard-earned, tip money from bussing tables and working real estate on the weekends and nights to buy my first 4-family property. It cleaned me out, and I didn't have any money left. Right? I had a great place to live, rent covered, but in terms of my scale, I had to master the art of no money down or low money down, creative financing, and all that stuff. So when it applies to doing commercial deals, the same thing is going to apply. You may have the money for your first deal, you blow it. It's going to take a long time to replenish that reserve, right? So many, many years. So there could be smoking hot opportunities that can slip through your fingers in the process with having capital as your bottleneck. And also you have to have an ever-growing sphere, because if you have a rich uncle that sold this printing company for $30 million last year, that's interested in investing with you on your first couple deals, your rich uncle is going to run out of money eventually too, as you're growing and scaling, right? So these are 5 different capital sources that you're going to want to be aware of. The first one being the most obvious is cash. All right. And cash is, I know it sounds boring. Like it's like, oh, duh. Like, obviously somebody could, put their cash into your real estate opportunity. But starting with this is there's a lot of people that are out there, very, very unsuspecting people. Wealth does not shout, it whispers. They drive a Ford Taurus or a Ford pickup truck, wear modish clothes, don't wear fancy jewelry, anything like that. That are people that are in your sphere of influence that have a lot of cash that is not working for them. All right. So getting to know people that actually have money. All right. All of your broke friends and broke family members, if they're all broke, they're probably not going to be the best place to raise, $5,000 or $10,000 a pop. We're talking about big check writers. So you have to be in the rooms with people that have big checks to write. So the next one is HELOC, home equity lines of credit. The home equity is the biggest source of wealth in the United States. I know it's sad that we have our biggest investment in a liability essentially, but it's true, right? There's a lot of Americans that have $100,000, $200,000 worth of equity in their home. A lot of people take this equity as like a trophy, right? It's like, oh, I only owe $50,000 in this house and it's worth $300,000, right? Big deal. How is that equity actually working for you? That is dead equity that produces no cash flow. So how do you get other people to actually get that cash, to get that equity to work for them, right? So a HELOC is a home equity line of credit where somebody can actually get a second mortgage on the property through usually a credit union. Credit unions love HELOCs for the reason that credit unions, small credit unions and community banks don't have a ton of cash on their balance sheet to do big hundreds of thousands to millions of dollars worth of loans. So they like to lend against home equity in second position. And this line of credit works on it so that you do not have to pay interest if you don't use it. So you can open up a home equity line of credit. If you have equity in your home, open a HELOC right away. Research your credit unions that are around town. Find out which ones have the most advantageous terms from the standpoint of having max LTV. A lot of credit unions will say they do a max LTV or a loan to value of 80%. There's other credit unions out there that go up to 90, 95, even 100%. You just got to do your due diligence and homework. And the first place to go is if you're not in a local meetup or a Facebook group or on Bigger Pockets and connected with local real estate investors, just putting a question out there. Who has the highest LTV HELOCs in this group here, right? So that's a source of capital for yourself. I'm not saying use that, but if you have home equity in your home, opening up that line of credit costs you nothing, right? The bank usually covers the appraisal and processing fees, and it will only charge you if you close that equity line of credit, right? So might as well do it. If you're going to raise capital from people that are in your sphere of influence, friends, family, or professional contacts, you having this equity line of credit open yourself and knowing you have it as a tool is a lot better position from a credibility standpoint. And to talk to them is like, hey, if you talk to your people in your sphere of influence, I've always wanted to invest in real estate, but I just don't have the cash. It's like, oh, well, I just opened up a home equity line of credit 6 months ago, and I'm actually going to be using it for my first real estate deal. Like, you should actually open up one yourself, just so you have that flexibility and a credit facility to work for you. And by the way, if I'm going to buy a commercial property within the next 12 months, if I had an opportunity that I liked a lot, would you be interested in hearing about how I might be able to participate and go along for the ride with me, right? So all this discovery process, conversation, and education happens early on before you ever need to raise a single dollar, because it's going to take some time. And I have future trainings on this. It's going to take some time to prime the pump for your deal flow, to start getting off-market deals sent to you either through commercial real estate brokers, other investors, or from direct to seller, which I train on that framework in terms of finding off-market deals direct to seller as well. So it's going to take a lot of energy on this. So you want to start right from the get-go on reaching out to your sphere of influence on what direction you're going into right now. This is a theme of this video. If you have the resources, do this stuff yourself, do it, all right? It adds to your credibility. All right, so the second is, and I love this one, right? Home equity line of credit. If you borrow from somebody that has a HELOC, they're going to have a certain percentage interest rate on that HELOC that they're going to have to, basically make a margin above what their interest payment is, right? So they're usually going to want a cash flow from whatever you're promising them from day one, right? Which you're going to have to factor that into the deals you underwrite, making sure that you can actually preserve those payments to them with a lot of cushion as well, because you're dealing with people's home equity, people's homes, right? If you do not make the payments and you go belly up, they could lose their house. This is how sacred you have to treat this stuff, right? So second is the third, I should say, is self-directed IRA. Not a lot of people know about this, but typically a lot of people think that their IRAs, they're hamstrung into investing in stocks, bonds, mutual funds, ETFs. And most traditional IRAs, or all traditional IRAs, you are hamstrung into what you can invest in. Not many people know that you can convert some or all of an IRA to a self-directed IRA, which allows you to invest in alternatives outside of marketable securities like stocks, bonds, mutual funds, and ETFs, which includes lending money on real estate deals. All right. So doing private lending, so they can take that money that they convert into a self-directed IRA and lend it out in a tax-deferred, tax-efficient method using retirement funds, and lend you money at, let's say, 9, 10, 11% interest, whatever the deal supports, so that you can actually do that. And the beautiful thing about it is this: they don't need the money right now. These people do not care about interest payments. They care getting their principal and interest back when you're done increasing the value of the underlying commercial real estate asset you're buying. So this self-directed IRA is perfect for that because it's patient money, right? So you can say, hey, would you prefer to get cash flow into your IRA from day one, or would you prefer to have your money compound each year, right? Most of them are going to say, I don't need the money right now. Besides, it's a pain in the butt to take your check in that's made out to my self-directed IRA, which is and then there's self-directed IRA custodians out there. Equity Trust is one that I use. Look them up. Do your own research, find out which one's going to be best for you. But an IRA custodian, when they send you an interest payment, or when you send them an interest payment, you have to send it to their custodian, and it's got to be made out to Matt Druin or Equity Trust for benefit of so on and so forth, with a voucher ticket, and then get processed that way. It's very inefficient. So a lot of times it's just advantageous to do an interest accrued type of private money loan when you're looking to raise money for your commercial real estate deals, right? So that's a self-directed IRA. Again, going back to the theme, if you don't have a lot of money, but you have money in an IRA, even if it's 10 grand, convert $5,000 of it to a self-directed IRA, right? It adds to your credibility because you've gone through the process. You know actually how to walk somebody through the process. And it's like, oh, it was easy. I opened up one equity trust. I sent in some paperwork. They took the IRA proceeds out of my Fidelity account and they put it into my equity trust self-directed IRA account, right? And and I made a small loan out to a real estate investor, and I made 12% of my money or 15% of my money or whatever. Okay, this is what adds to the actual credibility process when you're doing this, and also you can use it for yourself too. But just keep in mind, there are prohibited transactions with self-directed IRAs. So you cannot take money out of your self-directed IRA and put it into one of your own real estate deals, and one that you're going to manage. All right. So you have to talk and be very, very savvy on what prohibited transactions are, because you get penalized and you can have that those IRA proceeds forced to be distributed to you and then be subject to taxes and penalties in the process. So the fourth capital source, this is one of my favorites, are S blocks. These are securities-based line of credit. If you have a non-retirement asset portfolio of stocks, bonds, mutual funds, ETFs, you can actually get a line of credit with the brokerage house, whether it's Merrill Lynch, Fidelity, Charles Schwab, whatever, up to a certain loan to value against those securities, and use that line of credit just like you do a home equity line of credit, right? So this is a perfect scenario when you have somebody who's like really into stocks, or even has a lot of assets that are, they're in retirement. They're no longer taking distributions out of their retirement assets or pension, and they're putting it into marketable securities like this. You can get a securities-based line of credit with some brokerage houses up to 80% loan to value. So if you have $1 million in, like, let's say a S&P 500 index fund, you can get up to $800,000 as a line of credit. Very flexible, just like a HELOC. You can actually lend out of that S block and fund real estate deals and get fixed income off of that. I love this. One of the things that a lot of times when you're going through the discovery process with potential investment partners, you're going to have this question come up. It's like, hey, I'd love to do get into real estate, but I got most of my money tied up in the stock market and I don't want to sell securities and, trigger a capital gains tax on it. Well, they don't. They can open up an S block, and a lot of them aren't even aware of it. And this is not margin trading. This is actually a line of credit you can write checks off of, or even transfer from one account to another and convert those loan proceeds to cash. And so the great thing about this, and also the important thing about this whole thing, is starting the discovery process very early on. All the people and clients that I train are experienced real estate investors. And when they start, their sphere of influence should know that they are a real estate investor. Everybody wants to own real investment property, but they have a lot of butts in the way, right? So in order to get the butts out of the way, coming from the standpoint of, hey, I understand you're curious in real estate investing. You've been following me for a couple of years. I'd love to sit down with you for a cup of coffee, for lunch, for dinner, for beer, whatever works, and see how I can help or add value. All right. And when you're going through asking the question, well, why haven't you invested in real estate yet? All right. What's holding you back? A lot of them are going to say, oh, well, I don't have a lot of cash. I was like, well, let's look at that. Do you have equity in your house? Do you have non-retirement securities, marketable securities? Do you have cash value in a life insurance policy, right? Which is where we're going to go to next. And then start to go through this and then educating them on how they could use those for their own real estate investments, right? A lot of people think that investing in real estate is they're going to do it on their own. They're going to go out there, they're going to find a duplex. They're a full-time physician or brain surgeon, and they're going to go out there and hunt down a property that has built-in equity from day one, run the deal. Also, it's a fantasy. There's a lot of people, real estate is just not the right avenue, direct ownership of real estate. So you're going to want to go from the standpoint of, hey, I want to share my quote unquote secrets with you, pick my brain, right? And then counsel them through the different ways they can actually invest in real estate, so that when you end the conversation with this potential investment partner, it's like, hey, I just want you to know, I'm looking to buy a larger commercial apartment deal or a larger industrial deal within the next 12 months. If I found a deal I really liked a lot, would you be interested in hearing about it? All right. So now they're educated on these different avenues that they can tap into. You do not want to be educating somebody on what an S block is when you're actually looking, when you have a deal under contract, you're looking to raise it, right? Because all this stuff is going to be like, just foreign, confusing stuff. You want to set them up with enough information that they can do the research on their own, because the investors that you want to do deals with are discerning consumers, discerning investors. They do their homework, they do their research, which is great because you do not have to educate them that much. You give them enough information that they can actually educate themselves. And they're so much more easier to convert to an investment partner later down the line. All right. And I go into much more ways than on the specific discovery process in later trainings, but I just wanted to start with that. All right. So my fifth and final one is cash value of life insurance. There's two types of life insurance. There's term life insurance, which is, and a life insurance company will pay out a death benefit if you die between age this and that, between ages where you are right now, if it's 25 years old to 55 or 60, right? There's also, and then it expires. There's no more death benefit anymore. It's over. It's to cover expenses and also take care of your loved ones in the uneventful event of your death. If you're like, I'm not planning on dying at 50 years old, but if I did, I'd like to have my loved ones taken care of. The other one is permanent or whole life insurance, right? This is something that when you buy it and maintain your premiums over time, that thing almost like a mortgage, the payments you're making on the front end is paying for a lot of, fees associated with it. But you start to build equity in that policy over time. And those people that have whole life insurance, they're, and have been paying into it for 20 years, for instance, could have a fair amount of equity in that policy, or what's called cash value. That cash value of that policy actually grows tax-free. And sometimes it's between, let's say, like 6% over that time period. It's all dependent upon the actual individual life insurance policy itself. But that cash value builds over time tax-free. And then these people that have cash value, that's like, what do you do with it? Well, they can actually take that cash value and lend it to you as a real estate investor, and they can make income off of that. All right. This is a really, really great way. It's a non-correlated asset that they can use to go to work for them, besides just having the death benefit. Right. So one of the questions in terms of the discovery process, all right, here's some ways you can actually fund your own real estate deals and buying a duplex, right? Do you have any cash value in your life insurance policy? They say yes, then that's great. You say, well, you can use it for investing in real estate. So just going through the discovery process, the 5 different sources of capital. All right. So that's it. Those are the 5 sources. I have future trainings on capital raising in more detail. I have it chunked out so you don't get overwhelmed with 2 to 3 hour videos. I also have trainings on deal flow, which is the next thing after you've primed up your OPM or other people's money. Then how to find off-market deals using the 3 primary deal channels. And I go into underwriting, case studies, and future training. So I hope you enjoyed this. Hope you got some insight out of it. Please subscribe if you haven't done so already. I drop these trainings on the regular. It's no fluff, education-based content. And also, please drop a comment below if you have any questions. I'll actually put together another video in response to the question if it's something that I overlooked in this video. And I'll be sure to tag you in it as well. So peace, goodbye, have a great day.